Lyft reported earnings on Tuesday, and results were actually pretty good. The market's reaction was pretty negative on Wednesday. Early in trading, shares fell over 10%. There was a little bit of a recovery throughout the day, but this is one of those high opportunity stocks that I think has asymmetric potential, and the company is moving in the right direction. May not be moving in the right direction at the speed that the market wants, but I do like where they're going, and management announced a $500 million share buyback. So at the current valuation, given a relatively low market cap, that could take a whole bunch of shares off the market and give even more upside if they do reach the potential I think they could in Autonomy. So let's go through the results and how this fits into the vision of the future of the company. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for online content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go right to the results. I'm going to start with a high level look. Gross bookings for 2024 up 17% to $16.1 billion, 828 million rides, and margins are improving. This is really the big thing. Lyft, like Uber, has gotten to profitability because they've increased that take rate, leaned into their operating leverage in the business. And you can see that quarterly gross bookings continues to move in the right direction. The reason that you want to look at gross bookings is this is going to be basically the money that's flowing through the system. The bottom number here is actually the revenue that Lyft is reporting. So this is kind of like their take rate, if you will. And the purple part of this would actually be what goes to drivers. So Lyft needs to have a balance between how much are they paying to drivers, how much are they keeping as a company. You have to keep those drivers happy because that's the supplier in your market. So you want to keep the riders happy, but you also have to keep those suppliers happy because they're what are ultimately going to make that two-sided market work. But you can see with everything moving up and to the right, things are heading in the right direction. 15% increase in Q4 in their bookings to an all-time high. The number of rides are also increasing, 15% year over year. Where I think is a little bit disappointing is the increase in the number of active riders, 24.7 million. Remember, this is just a North American company. The US and Canada is the only place that Lyft operates. So I'd like to see that number of riders increasing, but clearly the riders that are using Lyft are using it more and more. And adjusted EBITDA, this is where you go back to early 2023, they were actually very, very close to losing money, even on an adjusted EBITDA basis. We're not even talking about net income, which includes all kinds of non-cash costs, but even on an adjusted EBITDA basis, now you're looking at a run rate of about $113 million. Free cash flow really improved. I'm going to get to that in just a second, but $766 million in free cash flow for a company that has a market cap of about $6 billion means that the valuation is pretty attractive. Price to free cash flow on a trailing basis of under 10 is pretty cheap for a stock like this. This is actually why management announced a $500 million share buyback. Now, their guidance for the next quarter, the first quarter of 2025, this is where things were a little bit disappointing for investors. $4.05 to $4.2 billion worth of revenues or gross bookings is what they're expecting. That's only a 10 to 14% increase year over year. Management talked about this a bunch on this conference call. Part of that is pricing pressure. So they want to be able to maintain their market share, got to be able to maintain profitability. So they are going to be in that 2.2 to 2.3 from an adjusted EBITDA margin. But if prices come down even just a little bit, that's going to hit your gross bookings. There are a lot of non-financial metrics that management talks a lot about on the conference call. So driver sentiment is improving for Lyft. That's going to be a key for attracting more supply. And then ultimately that increased supply is going to increase demand for Lyft. There were record driver hours. This is going to be correlated with the number of bookings. And all of this is just pushing all the metrics that you see here. This goes all the way back to the beginning of fiscal 2023. All of these are improving and moving in the right direction. Let's get to this cash flow number because I think this one is important. Cash flow for the year, this is the annual number, $859 million. This is cash from operations. So what are the big numbers here? Because basically break even, a little over break even, but you have depreciation and amortization, that's almost $150 million. $331 million worth of stock-based compensation. That's going to be taken out of net income, but it's not a cash expense. But that's a pretty darn big number for a company with just a $6 billion market cap, so something to keep an eye on there. The other big numbers are insurance reserves were much lower than they were a year ago. So that's going to be something that's going to be volatile. You can see that there was a positive in 2022, negative in 2023, now comes back to a positive. And there's also a benefit from accrued and other liabilities. So basically $500 million of this free cash flow is not really sustainably coming from operations. So it doesn't mean that it's not cash on the balance sheet, but you want to treat all these things a little bit different because we could see both of these numbers in particular go negative next quarter. All that said, you look at the balance sheet and it is pretty attractive. You can see that in current assets, you have $759 million worth of cash and equivalents, $1.2 billion worth of short-term assets. So basically $2 billion worth of cash and equivalents on the balance sheet, $1.4 billion worth of restricted investments. And then you do have liabilities. There's liabilities of $1.7 billion in insurance reserves, accrued and other liabilities, another $1.7 billion. But overall, I think a solid balance sheet, not a lot of debt, about $566 million worth of long-term debt on the balance sheet. So nothing to be too concerned about.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
So as I'm recording on Wednesday, Lyft shares are down about 6.4%. So it seems like the market's a little bit disappointed with the results. But at the end of the day, I think Lyft is moving in the right direction. They are a clear number 2 in the ride-sharing market in the US and Canada. Doesn't seem like they're going to expand internationally anytime soon, but they are in a really solid position and they have an interesting spot when it comes to autonomy as well. They have May Mobility, which is potentially going to launch later this year. Then they have another partnership with Mobileye that could launch in 2026. So that could get them into the autonomy business. And Lyft, as a number 2 player, as a smaller player, has more ability to upend their current business, especially city by city, than a bigger player like Uber does. Uber has millions of drivers. They would need to potentially upset all of those drivers. They were going to go all in on autonomy. So I think it's going to take much longer for Uber to do that. A little bit clearer path for Lyft. And if they are able to take market share, you have a core that's a profitable business, very good service that a lot of people really like. If you're able to move into autonomy, you could lower those costs, expand your addressable market, maybe even increase your margins. And one of Lyft's pitch is they have the infrastructure to help these fleet companies actually operate their vehicles. They have places they can clean vehicles. They're lining up financing for their partners. Lots they're doing to basically create the infrastructure to expand their business in ride sharing. So that's ultimately where I think there's a lot of value for Lyft. And shares are currently pretty cheap. Enterprise value to sales is about 0.9. On a forward basis, the price to earnings multiple is just 13. And I mentioned that management is potentially going to buy back as much as $500 million worth of stock. I think they're doing that at a pretty good multiple. So I think you get good value with a lot of upside. The core business is growing double digits. Don't forget that. This is not a bad core business. It just isn't growing as much as the market expected. And sometimes that's the best buying opportunity for investors. So I recently added shares of Lyft. If shares stay where they are now, I will likely add that over coming months in the asymmetric portfolio. But I think there was ultimately a lot to like from Lyft this quarter. Continues momentum in the right direction, but the upside, the real asymmetric potential comes with autonomy. So that may not be seen for a couple of years, but that could potentially be a decade plus tailwind for them, expanding that market, increasing that ride sharing market overall 10x or maybe even more than that, and could allow Lyft to take market share at the same time. But let me know what you think of Lyft's results. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.